We are, and certainly China is a topic which we could spend the next several hours discussing and may not even make any progress in terms of coming to an agreement on. Really, the essence of what we're saying in our report is that you need to consider not only the structural concerns which are top of mind for anyone watching China now, the much discussed bad debt concerns, excessive leverage, slowing growth, all those sorts of considerations, which are of course significant and worthy of careful consideration. But on top of that, we need to consider two other factors. One is the cyclical momentum in the economy and the policy cycle, which tends to drive those shorter-term cyclical changes in the economy. And the second is how much is discounted into the equity market. And on both those two factors, we see grounds for more optimism as we go into the second quarter. Now, as you're probably aware, the market, Chinese equities, particularly those, for example, listed in Hong Kong, had a very difficult first quarter. They made a trough, if we talk about, for example, the HSCEI index, the China H-share index, which is a popularly recognized one. That troughed at intraday at 9,200 on the index about 8 or 9 trading days ago. Now, since then, we've had a 9% very sharp rally. But it still leaves China down about 7% for the first quarter as a whole. Now, if we look at the last 3 years, China has basically mapped out what we term a fat and flat trading range. Basically, the market is traded between 9,000 on the low side and 12,000 on the high side. And there have been about 8 up and down movements during these 3 years. The average move has been about 30%, and the average duration has been about 4 to 6 months. So one of the points we've been observing is that in equity market terms, that this is a market which has been very difficult to have a structural view on, that you just sort of either buy and hold or sell and hold, because the average of the market has basically been flat, and yet you've had this 30% amplitude around that central tendency, which is about sort of 10,500 on the HSCI index. So what we're observing here is that, notwithstanding the concerns about the structural issues in China, the market still is capable of mapping out some quite significant cyclical ebbs and troughs. And if we look at the conditions which tend to be present when we have a cyclical upturn, there really are two things. One is a turn in the policy cycle toward a more accommodative stance. And secondly, and really as an outgrowth of the first, we have a upturn in terms of economic momentum. And that indeed is exactly the situation that we think we are in right now, where after a very slow first quarter, which we think is going to come in at about 5% in terms of quarter-on-quarter annualized growth, which is well below the targeted roughly 7.5% or even low-end 7.2% that the Chinese authorities have stated as their threshold growth target. So we're expecting that growth can pick up sequentially in the second quarter as we have easier financial conditions, as we have some mild fiscal stimulus in a number of different areas, as we have the renminbi having backed off in the first quarter by about 2 to 3%, which should have a lagged effect on external growth, complemented by the fact we think that the U.S. will improve from 1.5% annualized growth in the first quarter to about 3% in the second quarter. So we get better external stimulus, we've got a softer currency, we've got softening financial conditions, and we've got a fiscal situation which is turning more favorable, and all that coming when the market's at the low end of this trading range which I've just described. So we've had the first quite powerful bounce off that bottom. We're now at about 10,000 on the HSCEI index. We're about this sort of the 30th percentile of the 3-year trading range. And basically our view is that with the cyclical upturn, we can continue to ride higher within that trading range. And we think that gives us another 10-15% upside over the next couple of quarters in China. And that's something which we think is at least a tradable rally, hence the overweight designation in our regional asset allocation.